following recording originates from Radio Eastern 98.1 FM's fortnightly financial and life planning segment. Welcome to FLP's Financial Life Planning Podcast. In this segment, we'll be sharing with you the story about the richest man in Babylon, Part 2.
So starting the last three cures for lean purse and some of the potential strategies that go with that. Number 5 is making the dwelling a profitable investment. I'm sure it didn't cost too much to buy a block of land to build your house on 8,000 years ago, Russ, but we know a block can be very, very expensive today.
I can remember sitting on the beach with some friends of mine many years ago, and we were caravanning down at Pambula and looking up at the hill where all these bits of blocks of land and old houses were, and thinking, we should buy one of those between us. We didn't, of course, and then towards the end of our 18 years or whatever it was that we'd been travelling there, the value of those blocks of land up on that hill would have made us quite well off.
They would have.
So there's a lesson there.
There is. I remember my parents paid, I think, $6,000 for their first house in Shepparton, and it might only be worth a few $100,000 today, but a $6,000 investment in Melbourne might be worth $1 million or
That's
two.
Right.
Who knows?
Yeah, well, I see the price of houses and flats and things around town now.
It's gone crazy, and that will eventually cool off a little bit as well, just digressing, especially when interest rates start to rise. I saw this morning, one of the papers I read, the Sydney property market for the first time is down by 1.9% just for the quarter. So if you annualise that, it's close to 8%. We're not expecting to tumble over, and we don't want it to tumble over because Australians' wealth is $6.5 trillion sitting in property. The share market's not even $2 trillion. As important as the share market is, as much as we like it, it can be affected if property markets go in the wrong direction as well. So a cooling off would be good. And if you could arrange the property prices to come back a little bit, Russ, that'd be great as well, to help the younger Gen X's and Gen Y's get into the property market at some stage as well. So
as long as it still climbs gently.
That's it. In the longer term, it always does. We also forget that everybody knows about share markets going up and down, and acknowledging the rises can be sharper and the falls can be greater as well than property. But we believe we're about to go into the fourth decline of the property market over the last 20 years at some stage. We don't want it to be a big one, of course, as mentioned, but we tend to forget that it was only 8 or 9 years ago that property in Australia or in Melbourne went down by a bit over 10% in 12 months. So it can happen. Just be aware and ride it out, of course. So number 5 is making the dwelling a property investment, as we mentioned. But after you save 10% of your income, we then look to purchase investments, and whether that be in your own home or your superannuation here in Australia, or investments outside the super system, is very important. One of the things we do get a bit concerned about, Russ, is that the younger people stretch themselves financially by borrowing too much to purchase that first home, and then the mortgage repayments can be out of control. Another thing we need to be very aware of with low interest rates as they are, they will increase by a couple of percent at least. It might take a few years to get there, but it should be factored into the budget now when buying a property. Can I handle a 2% interest rate rise? So I guess the cost to family is really, really important, that we can manage that. And we do know that one of the biggest reasons for relationships or marriage breakdowns as well is the financial stress is a big component of that. We don't want to see a subprime situation all over again, of course. We also see, Russ, it's not uncommon for up to 60% of net income, so after-tax incomes, having to go towards paying the mortgages for the principal interest payments. So the younger ones in particular, how well will they manage a 2 or 3% interest rate rise in 2, 3, 5 years, however long it might take. So there are also commentary out there that some might say that against the great Australian dream, for some out there, it may be better off not to buy property and to rent instead. But it's having the discipline to still put some savings away over and above the rental payments, I guess. A strategy for those that have got a good level of equity within their portfolio, so we certainly would never recommend this type of thing if somebody was pretty close to the wire with their repayments and not a lot of equity. But if you've got 50% or more of equity in your portfolio, or sorry, in your property, one strategy is to look to redirect the principal payments. So give an example of a reasonably typical principal interest loan here in Melbourne of around $400,000 to say $500,000. The interest payments on that can be, for simple numbers, let's call it $4,000 a month or $48,000 a year. You can redirect the principal component of that. So let's, again, for nice easy numbers, let's just say the principal amount is $2,000 a month. If we're to redirect that into another investment and just go interest only, now remember, interest only doesn't mean you're going backwards as long as you've got the discipline to put the principal amount to work for you. So the typical 30-year loan, this gets a little bit complicated and we're certainly not giving advice here, it's just a scenario and option, but the typical 30-year loan on that principal interest scenario before it's paid off, if we're to redirect the principal amount and have the discipline to commit to that for the term, and just the principal component being reinvested in a growth style of portfolio of shares, commercial property, international, etc., say it could earn 9 or 10%, it'll take 18 years to accumulate the 500,000. So very, very simply, a 30-year term, by not paying $1 more off your mortgage or into an alternative investment, can reduce the time frame down to 18 years. So if somebody currently has a 20-year term of a principal interest loan, in other words, you can cut that back to 12 years. So just think 40% of the years or term can be taken off if you can find an alternative investment that gains you 9 or 10%. What we'll then say, though, if we're getting a bit tricky with a strategy, why pay it off at $500,000? So you can think of it as an offset account, but it's working much, much harder than the interest offset you're paying. And imagine letting that 500,000 continue to build and grow, still put you a couple of $1,000s a month into the investment portfolio, and at the 30-year mark, you can actually have more than $1.5 million. So you've still got the $500,000 available to you to pay off the loan at any time, but you might have $1.5 million, about $1 million plus still left over that can then go to other lifestyle things like holidays, you can add towards retirement, etc. So sounds probably more complex than it is, but it's a worthwhile strategy to consider for those that have got a reasonable level of equity in their home. So we've gone through the first 5 cures for a lean purse. There's 7 in total. Number 6 is ensuring a future income. So the way we can do that is, we want to have a good level of financial freedom, obviously, where your income is secure. So financial freedom shouldn't be tied to specific ages. So whether it's 65, the old pension scenario, it's now 67, it's going to 70 by the 2030s, or whatever the government decides. So what we're saying is you should decide when you want to retire and on how much. So whatever you want, some good planning can set you on the path to achieve that and build the steps to accumulate the assets to provide you with a future income. And that assumes good health over your working life, of course. So whether it's superannuation, whether it's a business that's going to continue on that you can still draw an income from in retirement, there's a number of ways to build an income in retirement. But what if something happens along the way? So there's 2 parts to this strategy. What we call family protection strategies, to make sure that the income still comes in, to make sure superannuation contributions can still be accumulated and paid so that you do get that comfortable and happy retirement as well. So family protection strategies can cost as little as 3% of net income or less, but unfortunately Australia is one of the most underinsured countries in the world. So whether it's life cover, total permanent disability cover, trauma, which is for your heart attack, stroke, cancers, etc., or income protection, they can all provide immediate income and lump sum needs when it may be needed the most. And the whole concept of ensuring your future income is to guarantee an income stream in retirement when you're unable to earn as well. Number 7 even 8,000 years ago. Whether it's a true story or a fable, Russell, it's still a good story. We're not quite sure, but increasing the ability to earn. So his little quote there, cultivate our own powers to study and become wiser and to become more skillful. So whether that be through an apprenticeship, whether it be for university studies, developing your skills and qualifications during the working life, even way back then, the more we can increase our abilities to earn, the more comfortable lifestyle we'll have in theory. So increasing your skills, qualifications, it helps you all the way through your working life, but ultimately in retirement. I guess one of our key roles is to add value to our clients on that initial and ongoing education. So we also educate our clients from an investment perspective and understanding the market situation without being too complex, of course. So his lessons are not new, the Richest Man in Babylon, but they're not complicated. It's really a case of back to basics when you look at the 7 cures for a lean Perth. They're simple and they're common sense, but someone once said, Russ, that common sense is becoming less common. So, interesting. What we then did, Russ, is tie this into somebody who would be the richest man in the world today if he hadn't given away more than $50 billion to charity. And the great Warren Buffett has made all of his money through the US share market primarily. People think share markets and tend to shudder sometimes, but really good share market investing is simply choosing good quality businesses or companies to invest in.
That's that common sense thing again.
It is. Yes. They think shares and I'll lose my money. Well, if you buy a good share for $100 but it goes for 90, but it's still a good share, you don't sell it and lose your $10 or 10%. So hang in there, and before you know it, your $10, your $90 will become $110 or $20. CBA is a great example of that. Commonwealth Bank started at $5 in 1995, got to $60 at the start of the GFC, got as low as $25, and here we are today in the mid-70s, even after it dropping from mid-90s a couple of years ago. But if we bought in at $5 and sitting at $75, we're feeling okay.
Yeah, not bad.
And that's not even counting the dividends of better than 6% a year as well. So some of Warren Buffett's fantastic quotes. So on earnings, never depend on a single income. So make investments to create a second income. On spending, if we buy things that we do not need, soon you'll have to sell things we do need. On savings, very similar to Richest Man in Babylon as well. Do not save what is left after spending, but spend what is left after saving. So again, it's the 90-10 rule, put 10% aside. On taking risk, never test the depth of a river with both feet. On investment, don't put all eggs in one basket. So that's the only concern about single investments. We heard a story from a client who had a friend who made a lot of money from the share market and had a large amount to put in. He sold all of his diversified portfolio and put into one stock, and of course that one stock went under. So on investments, on expectations, honesty is very expensive. Don't expect it from cheap people. So a bit of a cheeky quote there. So Buffett's own success story, he bought his business called Berkshire Hathaway in the mid-1960s for $11 a share. May 1977, under his management, they got to $100 US a share. They hit $10,000 in 1992, and it gets even better. Long story short, by 2007, they were trading for $150,000 a share. One share. Even his investment company is not immune to market movements, though. So the depths of the GFC in March 2009, you could buy one share for $72,400. Long story short, that's over $340,000 today. So we've gone from $11 to $150,000 to $72,000 to $343,000 Australian dollars today.
Yes, you could afford to take a bit of a trim off the top of that and still be in pretty good shape.
And it's a great lesson for writing it out, because they have evidence that 75% of all investors in Berkshire Hathaway have actually lost money. How is that possible when you've got a share that's gone from $11 to $343,000? It's because people make emotional and irrational buying and selling decisions. So they sell when the market's low, and they buy when it's high. And we should do the reverse of that, and that's one of our roles, to turn that around. So ride out the highs and lows. So just to finish off for us, one of our favourite sayings, or our favourite saying really, is it's not about dying richly, but living richly. So it's not about dying rich, but living rich. And that may not have anything to do with money. It's about the quality of life.
Quality of life important.
Yes,
Exactly.
living life with purpose.
Thank you for listening to this edition of Financial Lifestyle Partners podcast. Please note, the information provided in this podcast is of a general nature and does not factor in your personal circumstances. If you require any assistance with your own financial life planning needs, we would welcome you to contact our office on 03 9873 4000.